I'm Amy Thompson, and I'm the Director of Marcom and PR here at Fundify. We are so glad you're spending this hour with us today. We're going to dive into one of the toughest topics for startups, determining valuation. And our guest speaker today is Tony Drexel Smith. Tony is the Chief Consultant at Capizate, Inc., which is a fintech that specializes in business finance documentation and preparation along with due diligence. He has served small to medium-sized enterprise business owners, startup entrepreneurs, and the business capital community by being an intermediary that specializes in developing and executing professional-grade business finance documentation and valuations. Tony has heard more than 10,000 elevator pitches and has been engaged with more than 1,400 enterprises since 1995. He's even an expert witness in court cases involving valuation. So we're so excited that Tony is with us today, and I know you guys are going to learn so much from him. So thank you for joining us, Tony.
Happy to be here. Thank you.
Great. This panel has so much incredible information to share, so we're just going to dive right in. I'm going to turn the screen over to Craig and take it away.
Thank you very much, Amy. Really appreciate it. One little housekeeping item as we get into this today is that a disclaimer: this is an educational live stream, and there's no offer to sell, or it's not a solicitation or offer to buy any security to the attendees of today's live stream. Especially in any jurisdiction to whom or in which such offer, solicitation, or sale is unlawful. We're regulated by the SEC. So that disclaimer is to make sure that you know we're offering this live stream today, which will eventually be on demand because we're recording, as a resource to our startup and investor community. So that's the nature of what we're about today. So the topic is how to determine valuation. And Tony, I'm going to turn it over to you to talk about the topic and the things that we've got queued up for the folks today.
Craig, thanks so much. And Ben and Craig, it's been an absolute pleasure meeting with your team out there in Austin the last couple of days. What a fantastic team Fundify has put together. So thank you. And thank you for the opportunity to be here today as well. Valuations are a process by which you determine the value of a business. And the first step whenever you start a valuation is to know what is the purpose of the valuation. Understanding the foundational purpose gets us a really good, as Amy had described earlier, I've done a lot of valuations for a lot of different purposes. And so to give you an example, if someone is looking to raise money in a startup and we need to understand the value of the company in order to sell equity in that company, then that's a valuation for the purpose of raising money. And in that case, there's a certain amount of methodologies that should be applied, which we'll get into today. If you're looking to sell your business, then that foundational valuation could potentially be different, as opposed to selling a company that's growing and needing capital to grow. And thereby, most of the valuation methodologies are based upon the growth of that company and the future value of the company. Whereas when you're selling your company, you're selling the company based upon what it will look like at the point of sale, which is different. Amy had also mentioned the fact that I've done some court work as an expert witness. And in that case, you might have partner disputes, you could have shareholder disputes, there could be a divorce involved. I mean, there are so many different reasons why there may be a reason for a valuation. And also important is to note that Wharton School of Business and many other educational organizations, as well as valuation education programs, teach that there are nearly 2,000 different methodologies that can be applied when raising capital for a company or when doing evaluation in general. And so when you first start evaluation, let's just focus today's efforts on raising money for a company. And even more specifically, we can talk about raising money for a startup. When you build a valuation for a startup, it is a very unique model, because very often when you build a valuation, you would use financial records, you would use historical records, you would use what's called time series modeling and industry series modeling. And so if you've got industry series modeling, what that means is that you've got historical data that references the value of the business and the industry as a whole. And so you've got some monikers you can use, some base points and assumptions you can use based on an industry and how its growth is, whether it's growing or it's flat or however it may be trending. time series modeling versus industry series modeling. In time series modeling, you're utilizing the existing financial statements of a company. And so you might have 8 quarters worth of material so you can see where the trends are. You can see what the revenues are, the cost of goods, and the overall profit or lack thereof, and be able to build it all. However, with a startup, you don't have the advantage of utilizing that time series modeling material. And so what you've got to do is assess the company in other ways. And so when you're working with a startup, I find that it's best to first determine what industry sector and subsector is the company in. Now, when we look at those bits of information, and in industry, there are 22 established industries in North America. And you use the North American Industrial Classification System or a SIC code to be able to determine the industry for which the company's in. Once you determine the industry, then you'll look at the sector that industry's in. And typically, every sector has standardized methods for determining value. In some cases, it may be an EBITDA multiple, it could be a revenue multiple, it could be a discretionary income multiple, and so on. So there are a number of different methods that can be applied, but you want to ensure that you're applying the right method to the industry sector and subsector that you're in. Once we've established the fact that we can get a feel for what the industry standard is for that particular business, the next step then is to determine, are there any comparable businesses that have a track record from startup until now that we can make comparisons from? There are fantastic tools available today that were not even available a decade ago, such as Crunchbase and PitchBook and other tools that allow a professional or even the entrepreneur themselves to be able to pay a fee and garner information. PitchBook in particular has gone into a business model that's just fantastic for folks in my business. And what I mean by that is, if you have an account with PitchBook, you can search by industry, sector, subsector, specific transactions that have occurred over the past number of years or months. And the goal is to find a company that's in the similar industry sector or subsector, but also similar in the stage of development the company's in, similar in size, similar in market space. And if you can find similarities, you can then use those comparisons to be able to have another methodology applied when you're developing a valuation. The next method that's most often used with a startup is what's known as discounted cash flow with a net present value. Now, discounted cash flow with a net present value utilizes industry standard formulas. Those formulas are applied to future cash flow projections. And so in order to develop a net present value with a discounted cash flow, most often applying also a terminal value, what you're doing is you're building a pro forma. And in building a pro forma, you're typically building a pro forma for anywhere from 3 to 10 years, most often 5 to 7 years. And the purpose of that is to develop a forecast wherein you're defining what all the revenue streams are for the company now and in the future. And if it's all a startup, it's all future. Second, we need to determine what the cost of goods are for each one of those revenue streams. And then we need to apply any direct labor costs and other expenses that are needed to be developed in order to determine what is the gross operating profit for each of the revenue streams. Once you've established that, then you've got to build a fixed expenses worksheet. And in building a fixed expenses worksheet, you're now defining what all of the costs of running the business are, very often referred to as overhead. And so what is your rent? What are the phone expenses and so on? Then you'll build out variable expenses that may not be directly associated with the individual revenue streams, but are a cost to the company in a variable way. An example might be a merchant account wherein you're accepting credit cards or Square Up or some tool where you're paying 2 or 3% for each sale that goes through your business. And so now that we've got our fixed variable expenses, we have our cost of goods, then you need to build out a payroll worksheet. And payroll worksheets are forecasted, but you also have to determine the capacity of the business. And so it's important in a forecast that you're developing a financial pro forma that includes not only the payroll forecast, but what is the capacity of that payroll team to be able to produce whatever it is you're selling. So as an example, if you are in the restaurant business and you know that you need staff for your restaurant in the back of the house, the front of the house, you need a management team, but you figured out that in year 2, you're going to maximize capacity in that restaurant. So you're actually going to open a second restaurant. So when you're building your pro forma, now you're developing a year 2 or a year 3 or a year 4 expansion into a second restaurant. So I'm using a restaurant as a very simple example, but capacity is critical, because when you build out a payroll worksheet, I often see the mistake of entrepreneurs and startups where they have some level of growth for payroll, but they're not expecting or planning for the eventual growth and issue of capacity. And so once you've got your payroll worksheets worked out, then you want to add in all of the what's known as burden. It's kind of a negative term, but it's an important term because it defines what are all of the tax costs that are going to be associated with the employer contribution. It also includes Social Security, it includes FICA, it includes all of the expenses as it relates to payroll processing and admin benefits. And so once you work all of that through, now you've got your cost of payroll. You very well may have a variable payroll as well as a fixed payroll. Variable meaning there's a cost of goods and cost of services as it relates to an increase in labor cost. And then of course your fixed payroll, which is most often your management, your admin, support teams. And if you've got salespeople that are based upon, that their pay is based upon performance, you'll need to build that in. And if you have independent contractors, those independent contractors are most often applied to your variable expenses as opposed to being applied to payroll. But that can be based upon each business. It could be part of the payroll, most often not. It may be part of fixed expenses if it's a contractor that's on a constant, or if they're a variable contract, then you would put into your variable expenses. Once you've defined all of that inside of your pro forma, now you've got to build in marketing. So when you build a marketing plan in, the point of the marketing plan is that you need to be able to have a budget for marketing. You need to understand what your customer acquisition cost is going to be, and you need to know what your conversion rates will be, so that for every dollar that you spend, how many new customers are we getting based upon those new customers making purchases, how many convert to be a customer, and how long will that customer be a customer with you? Have you assessed what trailing relationship looks like, meaning how long after you've spent the marketing dollars can you then maintain that relationship through customer retention management? And so you want to ensure that you've got a marketing budget that's included in your pro forma, because without it, most often investors and others will look at your business and wonder how it is that you intend to grow without a marketing budget. And that marketing budget should be driving the revenue models that you built in the beginning. So now that you've built the general sense of what you're going to price your products or services at, and you've built in your cost of goods and sales, now you've applied the marketing costs as well. Once you've done that, now you can take all of those worksheets and summarize them into a summary, what's known as a summary pro forma, where you've got all of your revenue streams summarized. You've got all of your direct costs, cost of goods, cost of sales, direct labor, and then you now have a gross operating profit minus your fixed expenses, minus your payroll, minus your marketing. And at the bottom now, we now have net profit. Once you figure in your net profit, taxes, depreciation, now we've got free cash flow. That free cash flow is the amount of money that the company has to now either grow, build, pay out dividends, whatever the case, but that free cash flow is now your basis for developing net present value discounted cash flow. So when someone tells me they're going to do a DCF, and it's a term that's thrown around loosely, I say to myself, okay, there's a lot of work here because we need to develop an entire pro forma to be able to get to discounted cash flow. Now, what I'd like to do before I continue, because that was a lot to swallow, Craig, do you want to open up to questions as it relates to that part of the discussion?
Yeah, thanks, Tony. Yeah, let's take a moment. And a high-level recap is it's really important to look at comps for your business. And it's kind of the same principle in real estate. Comps kind of help drive the discussion. Unfortunately, oftentimes institutional investors have access to things like PitchBook and a lot of comp data that as a startup, you may not have, but there's ways. Also to build out these various elements of a forecast. And FYI, if you didn't see last month's live stream on financial forecasting for startups, That's available on demand too with Taylor Davidson at Foresight. So that might be an excellent tool if you're thinking, wow, this is a lot of stuff that I may not have thought through yet. Be encouraged. We're going to talk about how you get there in a few minutes. But if you have a question, please hit us up in the Slack, in the Zoom chat, and make sure that you hit the message drop down for everyone. So also we have in Q&A, Tony, give me just a second, I'll pop up Q&A. Where do you find the specific valuation methods that are used for each industry sector and subsector? Christopher's asking that question. Back to your earlier comment.
What I can do after today's talk is provide some data for research. When I train the folks that work for me, I give them a list of resources, and I can provide those resources to you, Craig, and you should share it with those that have participated today.
Great. We'll add that to the event on demand as resource links that people can make time to take a look at after. So thank you for that. Any other questions, please hit us up in chat or Q&A, and we'll answer those as we go. Tony, back to you to take us to the next level of discussion.
You got it. So if it's an existing business that has at least 1 year's worth of financial statements and or tax returns, we very well may include a book value. A book value gives us a real honest assessment of where the company is in terms of its value. When we look at assets minus liabilities, is there a net value there? Another that's very often used with startups is what's known as the cap value. So Craig had brought up a cap value earlier. A cap value is a very simple mathematical equation that says, what price did the most recent purchaser of equity pay, and multiply that price times the total amount of issued equity. And so a very simple mathematics equation says someone put the first $100,000 into the business for 10% of the company, then you now have a cap value of $1 million. And so if there have already been investments made by founders or early stage seed capital investors, angel investors, and that helps establish a cap value. And so the goal here is to find 4 methods that are most viable to the project. And so when I say most viable, what I mean by that is, do we have references? Do we have citations? Do we have information that can back up the assumptions that we're using? And the more validity, the better. And so in the case of, as an example, the cap table, if we know that there are agreements that have been signed, money's been transferred, and the agreement on the price and value and equity being sold is clear, then that's high value as far as putting together a valuation. Now, it's important to note that when you summarize a valuation, you should have multiple methodologies. I am not a fan of companies that just have a single method. And the reason for that's because having been involved in court cases and seen how valuations can be analyzed or overanalyzed, if you've got multiple valuation methodologies, then you're able to show a wide range of ways of valuing the same company. And by having multiple methodologies, you can also now run averages and, more importantly, weights. And so what I typically do is find the 4 most viable valuation methods for the project for which I'm working, and then determine what are the averages of each, the averages of all the sum total of them. And then what are the weights? And what I mean by weights are, the more valid a particular assumed valuation has, the higher the weight. So again, I'll go back to that comp value. If I'm on PitchBook and I'm working on a project and I see it, there's a true apples to apples comparison. We have a startup company that's hired us to do evaluation. We see it, there's a company that's 2 years old that's had transactions recorded on PitchBook. The company looks very similar in size, in scope, in marketplace, and they're raising capital for the same purposes. I would call that an apples to apples comparison. I can use that reference inside the valuation when I'm completing it. And so that comp value would have a high weight for us. Net present value discounted cash flow tends to have lower weight. And the reason for that is because it's so much built upon future projections. And there are court cases, even Supreme Court cases that are recent, that the value of a company solely upon future forecasting is not necessarily a valuation that has a lot of strength. And so it's important to back up net present value, discounted cash flow, and terminal values with as many other valuations that can offset that future model it's important that you do it. And in essence, when you do a discounted cash flow with net present value, you also have to apply a weighted average cost of capital, what's known as a WACC. You've also got to look at in the industry, beta, meaning the volatility within that industry. And someone had asked earlier about references. In referencing net present value discounted cash flow, New York Stern does a great job of providing a lot of references and resources as it relates to WACC and discretionary income. And when you're building net present value, there are a lot of tools at NY Stern. Now, once you've determined the multiples and the values that you intend to use and the methodologies you intend to use, then you can apply them to these weights. And so when I build out a valuation utilizing weights, I start with 4 models, 4 methods, and give them all 25%. Now you've got yourself an average. And then what you'll want to do is look at how strong is the validity of each one of the methods being used, and should you then adjust the weights. And as I already said, most often we're going to adjust down on the net present value and discounted cash flow methods because of the level of risk that's involved with them. We would typically increase book value if the value of the company has assets with value. And we would most likely increase the weight for comps if the comps are a good comparable comps. If you've got previous cap investments into the company and they have solid documentation behind them and they've been recent, meaning in the last 90 days, maybe even 120 days, 80 days most, those cap values can be applied with higher weights as well. So you take those weights and then you're able to apply them into the overall method of the evaluation range. So most often when we deliver evaluation, we will deliver it in a range. So we'll take a look at what was the average of the 4, what are the weighted average, and then look at a range within 10 to 20% of high, low, and somewhere in the middle. And that middle number is typically the one that we use for discussion when deciding what is the final value that we intend to apply to the particular project. I'm most often asked, how long does it take to do evaluation the way I just described it? And it really depends on a number of different issues. Assuming that it's a startup, assuming that there's no previous revenues to work with, there's no financial statements to work with, it actually takes a little less time because we're basically going to use industry established averages and plug in the assumptions that the company has developed. If it's an existing company that's got 2 years worth of tax returns and financial statements, while it will take longer, the valuation will have more validity because there's more information to work with. However, it takes longer to analyze it. So look, I've been doing this for 27 years, and I have met a lot of valuation experts in my career, and some of them will tell you that valuations for startups can cost $10 to $30. I think the average cost that most people will charge is in the $25,000 range. I am not a proponent of that, to be candid. If we're dealing with a startup, we're talking about budgeting here. We're talking about not a lot of capital typically to work with, and a sophisticated valuation for a startup should not exceed 100 hours worth of work. And really, the reality is that most often it should be able to be done in less than 20 hours. And so, based upon whatever hourly rate you're charging, it shouldn't take as long as people think. I think typically 2 weeks, 40 billable hours, you're probably right on target.
Cool.
Craig, I'll stop for Q&A. Go ahead.
Yeah, I've got one other question that came in here, and then we'll talk about the question I'm sure is on a lot of people's minds is, where do we go for resources? How do we make this happen? If I've got a back of napkin idea and I don't have all this other stuff teed up that you've talked about, what's the least path to get some of this queued up? So one of the questions from Mark, he said, can you speak to R&D and new product development in the valuation calculation? So you can briefly speak to that, and then Ben has a couple of comments to follow on as well.
Sure. So the valuation of a patent or intellectual property or R&D is a specialized field. I have done many of them in my career, but it is a specialized field. And the reason for that is because we need to make sure that we're speaking the right language and what industry we're in. Is this biotech? Is it an app or a technology undeveloped? It depends on a lot of factors. But at the end of the day, when you think about the R&D, it comes down to what's the value of the product in the future based on that R&D coming to fruition. And more often than not, people focus on how much money they've spent on the R&D. But the reality is that money very well may have been well spent. It may have been over budgeted and overspent. So it doesn't necessarily have a lot of value as to how much money is spent on the R&D. The truth is, we need to understand better, what is that R&D really producing? Is it ultimately a product or a service that will produce revenue? And if so, then you need to apply revenue modeling in order to determine value.
That's a great point, Tony, because often I've looked at companies with various levels of IP. A lot of it's aspirational. And so you've got to get a sense of how real is it and how does it speak to the valuation in that particular sector. I wanted to invite Ben to talk for just a moment about the resources available at Fundify and his startup success team that he leads as it relates to more information on this. And then Tony will come back to you and talk about resources that you can speak to with regards to helping people and equip them. And a related question, think about this in the meantime. When should people start this? In terms of their funding cycle, is this something they should get to right at the beginning, midway? I mean, it's a very, very variable question, but just in general terms, think about that and we'll come right back to you in a second.
Sure. So one of the things that I know, part of our disclaimer at the beginning of this conversation was we are a funding portal, which means we cannot provide guidance, we cannot provide consultation to the startups that work with us. It's one of the reasons why we love working with companies that come to the Capizate companies or similar services groups, because they come having already had that diligence prepared, and they walk in with certainty. They know what their valuation is, and they know how much money they need. They understand how much you're going to get diluted on that valuation. And doing that level of planning really prepares our issuers for success. It prepares our issuers with sound expectations of how to work through the platform. And oftentimes, as we have conversations with issuers, who we call our startups issuers internally, but our startups, is we often have this conversation of, how much money are you raising? How much money do you really need? And do you understand how that impacts your valuation? Do you understand the level of dilution that is going to come by raising that much money on this valuation? One of the tools we use a lot is referring out to companies like Capizate, referring out to other services partners that are able to do that deep level of consultation. As Tony was saying, this is not about a simple tool that you can just plug some numbers in and get your valuation, but it requires understanding of the industry, understanding of the nuances of your business. The other component to this, and someone else put this in the chat, is how much money someone else is going to pay you for your company or for a fraction of your company. And it's one of the tools that we use as part of the system at Fundify. We call it a fast pitch preview, which many of you who are in this conversation are actually currently doing a fast pitch preview with us or went through that process. Because so often your valuation is market-based. And how much you're going to raise at that valuation, your expectations of that can be market-based. And we use that fast pitch preview tool not as a way to I'll use the term clinically validate your valuation, but to validate it in the market to understand, can you raise the capital you need at a valuation that you can support? So we highly recommend our companies use that tool, get that validation from their existing investors, from their close network, their family and friends and their advisors, who say, is my justification of my valuation through my pitch compelling enough that you will invest in my company? And that really is very often, especially in the context of Fundify, why we're doing evaluation, why we're all here, is to successfully make that transaction to fund that business to its next business milestone.
That's a faster path too. While you're preparing your full campaign, these are known as in the industry as test the waters campaigns. But while you're getting all your other ducks in a row with valuation and other parts, fast pitch can be a quick way to kind of put a finger in the air and say, what kind of traction are we getting on the current pitch, the current value, and so forth. So thanks for that, Ben. By the way, just another disclaimer, we refer to different companies to help with these kinds of services. Capizate is one of those, and we take no referral fees or revenue share or anything from that. we provide resources, educational, informational, and professional services resources that startups can go and explore on their own. I just want to make sure that we're clear in stating that. So Tony, back to you. Two questions. One was the timing. When in the process should an entrepreneur or founding team be thinking about this? And second is just additional resources that you recommend. And folks, please keep posting questions either in the Q&A or in the chat, and we'll get to those as we start to wrap up here in a few minutes.
Well, there's no doubt that you need to be able to have some level of a value when you are posting a testing of the waters. And so well before you're posting and you're testing the waters, you should understand what the value of your company is. As Ben had stated just a few moments ago, very, very often when we first interview a client, and I mean very often, I don't know how often, but I'm going to make a wild guess of 40%, 4 out of 10 people, I'll ask them, how much money are you raising? How much money do you think your company is going to earn in the next 5 years? And the most often answer, 4 out of 10 times, I need $1 million. I have $1 billion idea. I hear it so often that it's like almost a joke within our office. It's shocking how often I hear that number. They need exactly $1 million for this $1 billion idea. Well, more often than not, that's not the case. And so we really need to determine how much you really need, because you as an entrepreneur have to be able to come to a gut answer for yourself as to what you're comfortable selling to. And you'll also have to recognize what is the market willing to bear. And that's why this testing of the waters is so awesome, because it allows an opportunity for you to post what you think your value is with a price and see what the investor response is. As an example, let's just use simple numbers. You think you need that $1 million, and you've got a good use of funds that shows that $1 million is the right number. And in your mind, you're willing to give up 10% of the company for that $1 million. So you're going to post on testing the waters that your company's worth $10 million and it's a startup. And you may post that and then find that, hey, what if the testing the waters, hundreds of investors looked at your deal, but only 10 people engaged and you didn't raise very much money. That gives Fundify and you a real world reaction to that, $10 million value. And that's where you'll need to take the time to really do a proper valuation so that you can defend it. And so you can promote inside your offering why you think it's worth that much, or less, whatever the case. And as far as dilution goes that Ben just described, dilution is exactly what we just said. You want 100% usually in the beginning. And as you're bringing on investors and shareholders and equity partners, they are taking a percentage of the company that you would have otherwise owned. And that is by definition dilution. We recently posted a project on Fundify that initially the company was only willing to sell 10% of their business, but they wanted to raise $5 million. Well, that's a $50 million valuation on an early stage company. So that's a bit aggressive most often. And ultimately, the client did hire us. We did do a valuation. And what we determined was that they needed to sell more like 24% of the company as opposed to 10%. And that adjustment made all the difference in the world. And so far, so good on their testing the waters now today. As far as resources go, Craig, as I mentioned earlier, there are many. There are organizations that teach valuation. There are a number of associations for valuations. There are tens of thousands of professionals that do valuation work. There are colleges and universities that publish a lot of materials that relates to valuations. We tend to lean on PitchBook a lot because PitchBook is the industry standard for us because they provide so much data. Crunchbase is another great resource. But again, as I mentioned earlier, I will provide you with a summary of tools that are available to people where they can access them, typically at no cost, and give you some ideas as to where you can find more material and more information. If that answered your question, hopefully it does. Are you still there, Craig?
Yeah, actually, I was listening to your discussion of those different resources, and I guess one thing that came to mind was which of those are kind of rabbit trails, or because I've done this before. I could spend an inordinate amount of time kind of chasing my tail on trying to get to evaluation. What is in your mind, just to encourage the folks too, give them some hope here, what's like a shortest distance between two lines for someone who's got a concept, they think they want to get started, they don't have a lot of time and energy, they probably have a full-time job, and they just want to get a finger in the wind idea. They don't have access to PitchBook and that license. What's a way that they can go about developing comps or just some back of napkin idea to help them? Or
Well,
even
just kind of
guideline, like if you're raising $1 million, is it 10%? Is it, you just, there are some guidelines that people kind of recognize in the industry.
Right. So we have to, first of all, establish is how much money, energy, time, and people have gone into the startup. If we're working, invested their own capital, they brought in family and friends capital, that's a much different conversation in terms of that knee-jerk reaction, quick assessment versus someone that hasn't put any money in at all. And that's a critical conversation, right? And I mean, I'm sure, Craig, you've worked with 2,500 companies. I've worked with a lot too. And we both have ran into this where an entrepreneur that's put in everything they have, that they savings, checking, they borrowed against their mortgage, they borrowed against their 401k, they've put together everything they've got and poured everything they have into it. They're going to have a much better argument as far as that. Put your finger to the wind. Let's come up with a value that's fair and for the early stage investors, versus someone that has put in no money and they don't have any owner equity in the deal. Maybe they've got a fantastic idea. Maybe they've developed a patent. But I know both of us have worked with a lot of entrepreneurs that put in less than $10,000, but are requesting an awful lot of startup money, but not willing to give up a lot of equity. And when that happens is when we have to apply the kind of methods I described for 30 minutes early, because we've got to be able to set some standards that make it more reasonable to be able to get to a fundraise that's going to actually succeed.
Yeah, that's a great answer. And yeah, how much skin in the game is often an indicator. I'm going to send it to chat a rather long question from Peter. So take a look at that. And also in the background, if you could think about the question of how often should a company's valuation be updated? So maybe start with that and then answer Peter's question, if you would, repeat it for the rest of the team, the attendees. And then we'll look for any final questions, folks. Please post them on chat or in the question or the Q&A in Zoom.
Well, valuations should be updated at least once a year, but also they should be updated whenever there's a potential for either a liquidity event or any sort of capital raise event. And so a liquidity event meaning you're going to maybe sell the company, or you're taking it public, or you're going to be doing distributions of some kind. Maybe that you're buying out a previous partner. Anytime that there's going to be a significant change to the balance sheet, a valuation checkup is probably a good idea. And then doing it annually just to get a sense for how the company's doing. And anytime that you're going to do a buy-sell agreement meaning that any of the key partners in the company, that the company would not function without them, there is a need to develop a buy-sell agreement. And in that buy-sell agreement, you should have a valuation applied to it as well. So there's a number of different triggers as to why and when you would most likely want to make sure that you're updating your valuation. So the question that Peter had asked was, if all the previous funding for a startup came in pre-money safes, does this rule out using the funding as one of the components of the weighted valuation? No, so the safes can be applied as part of that cap value. So if ultimately I would obviously need to read the safe and understand what the safe says. There are 4 or 5 different safes with caps, without caps, with valuations, without valuations. And so you need to look at what the safe was. But ultimately, let's just use the safe most often that I'm using, which is you've got a valuation cap. So most often, and in fact, I was just involved in the safe a week ago where the valuation cap was $10 million. Company raised $1 million in seed capital with a 20% discount applied. So ultimately, those that put in $1 million will have the purchasing power of 1.2 on a $10 million valuation. And yes, that cap essentially tells us that the value of that company was with bona fide purchases made through a safe. So it gives us a good starting point anyway. and a simplified way for us to at least have a basis to work from. So yeah, I don't have any reason why I wouldn't apply a SAFE. Let's see if there's other questions here I can apply.
Yeah, here's one. No, Peter just said thank you. Tell the attendees a little bit, the folks on the live stream, about what Capizate does and how you work together with Fundify startup companies. So just a few seconds on that.
Sure. So we're in the business finance documents and due diligence business. We developed an objective scoring system that looks at 334 attributes or puzzle pieces of a company. It took me about 10 years to develop that process. 100,000 man hours went into the study to determine what are all of the attributes that build a business. And whether it's a startup or any stage of development, we're industry agnostic as well, and we're able to develop a score that gives us a good indicator as to the fundability of a company, as well as its propensity for success and or failure. We also develop a lot of business finance documents, from business plans to pro formas to business model canvas, pro forma work that includes everything I defined earlier, as well as valuations. And so we're a business finance documents company, and we're most often known for our due diligence, though, putting together, making sure that we can validate all of the claims of the company, claims as it relates to industry, market size, market penetration modeling, the actual need for the product or service within the market space. I mean, I laugh, and so do you, Craig. I mean, how often do we hear someone tell us they've got a great idea that's never been done before? And usually within an hour, I can show that there's potential for other people with similar ideas. The question really becomes, is there a market space for it? So anyway, that's a quick summary of what
my pithy response is always, hey, for every idea in Austin, there's 2 in Boston and 5 in San Jose. So it's all about what you said earlier. It's about execution at that point. So you've got to execute on your idea, on your plan, on your funding. And again, that's where Fundify can help you. We have an extensive online knowledge base that talks a lot about all the elements of how to prepare and become ready and execute your funding campaign in equity crowdfunding, and many related topics as well. So, well, folks, it's your turn. We've got time for a couple more questions. Please hit us up in chat or in the Q&A. And Tony, sure appreciate all the information and advice, experience, and wisdom you've shared with the team today. And Ben, do you have any final questions for Tony?
No, we're good.
Yep, cool. And folks, if you'd like to connect with us, we'll keep looking for questions here if there's any additional. But to connect with us on Fundify, you can go to our site. You can scan this QR code if you like. It'll take you right to the site. You can also email us at startups@fundify.com, or if you're interested in investing in startups, there's the email for investors@fundify.com. We're also available on social media across various platforms. Once again, as a disclaimer, this is an informational live stream webinar today, not meant to sell or offer any securities. So I want to make that clear to you as well. And so in closing, Tony, thank you very much for your time today. Everybody, thanks for joining us. I'll throw the final word to you, Tony, for any comments or thoughts you want to share.
No, it's just a great honor to work with entrepreneurs. When I speak about valuations, and it's not exactly the easiest part of launching a business, developing a value. I appreciate the way that we approach it, in that we're providing multiple methods and doing weights so that entrepreneurs can feel more comfortable that they're making the right decision about their business. I was an entrepreneur, have been an entrepreneur, and I am a big proponent of being on the entrepreneur side to help them make good decisions, so that they serve their investors and their clients and their employees. I have a passion for doing this and love doing it, and just know that we're here for the entrepreneur, all of us on this call.
That's great, Tony, and I agree. And listen, if you're an entrepreneur or startup that would like to figure out a path and a plan to raise funds, equity crowdfunding, whether you want to start with a fast pitch, test the waters, or go right into a campaign, you can go and join now at Fundify. It costs nothing. There's no obligation to start the process. And for investors, it's always free to invest on Fundify. Also, just to let you know, we have on-demand and upcoming events. You can sign up for our weekly newsletter, and we'll keep you posted on that, as well as other things that might be of interest to you in the future. So Tony, thanks again for joining us today. Everyone on the call, appreciate you spending some time with us today. Please hit us up with any questions that you might have. following our time. Otherwise, for Ben, Amy, and the team here at Fundify from Austin, Texas, thank you and have a great afternoon. Thanks, everybody.
Thank you all.
Thanks. Bye now.